In this video, traders, we're going to look at cTrader order type, and one of the market or one of the platforms you can use is cTrader. They also offer MT4 as well for you guys who like your MT4. So cTrader, a good platform. One of the things that is handy or nice about are the 4 different order types that I offer on cTrader. You've got market order, and the ticket looks like this for market order. You've got limit order, ticket looks like this. You've got the stop order, ticket looks like this for the stop order, and for your stop limit order the ticket looks like this. But the important thing is when we use them. The simple, relatively simple, guys, to understand how to put your orders in and stuff, and I've done other videos before we've gone into that kind of level of detail. But really what I wanted to cover in this video is some of the kind of times when you might want to use these different types of orders, because it's nice having the option to use these orders all very well, but actually, when do you use them? When do you kind of go, hey, that'll really fit nicely? So market order, pretty standard, guys. You know the score of this. You're either buying or selling. You put in your position size. You obviously make sure the market is the market you want to trade. You put in your position size. You hit buy or sell, and the server checked against the price, comes back whatever price that is. That's the price you get filled at. And guys, instantaneous fills, super quick. Mostly, unless it's a super fast market, the price you hit is the price you're going to get. Sometimes you might get positive slippage. Sometimes you might get negative slippage. That's the downside of a market order, because the market order basically says I've got a disregard for price, but I just want to get into the market. So if you buy and the market has moved up a little bit, you might end up paying a little bit more. So vice versa though, if you buy and by the time your order hits the servers and back and the market's moved down a little bit, you might get a slightly improved price. So it is what it is, and that you're basically giving up price sensitivity for time sensitivity. And very simple way to execute that. Limit order is when you're waiting for the market to come to you. So if we kind of draw some standard market action here, a bit of range bound, bit of a breakout, pushing down like this, and you kind of say, right, how would I frame my order? So a limit order is basically saying, hey, I'm not sensitive on time, but I'm very sensitive on price, and I may not get filled because I want the price to come to me. So an example might be, let's say you've got a low here, and you think if the market comes down and double bottoms again, you'd like to buy it. So if it comes down and hits this level, and imagine this level is, let's just call it 1,000 for now, just to kind of round number, just to for example purposes. You don't want to buy until it hits that level, because that's your thesis. Your thesis is the market comes lower, you want to buy again, you think it's going to double bottom and it's going to push back through the highs. You don't want to buy it now, you think it's too high off the low. The way you framed your trade is in that way. So this is where you'd use your limit order. You put your limit order, your position size, your level, and you wait for the market to come to you. If the market went off into the stratosphere, hadn't come back to that level, you're not going to get filled. If the market comes down and then pushes off, you're going to get filled. Now, obviously, you now also want to protect your orders with a stop order. Now, a stop order, guys, can be used to protect an order against loss, or further loss, or extreme loss, or more loss than you're comfortable with, really, or it can be used to get into the market. Let's talk about these different scenarios. So imagine if you'd gone long here at 1,000, and imagine you said, you know what, I don't want it to go any lower than this level here, and imagine that is 980, just for our argument purposes, and you say, right, that's where I want my max loss to be. If it goes lower than that, I don't think the trade's valid. I want to basically take my profit, don't lose any more than the difference between that and that times my position size, and move on. In which case, if you're long, you put a sell stop order in at 980, bang, you're simple. I think you guys know how to use a stop loss. The other way of using a stop is to get into a trade when the market's moving in direction. So breakouts are a kind of perfect example of when you might use a stop order to enter. So imagine you thought, right, you know what, I'm not interested in all this, but if we break out above this level here, above this high here, you think it's going to run on further, you can't use a limit, because a limit you're going to use a sell or you're going to use a buy. You have to frame the price. The price has to come down to you or up to you, and you're fading the kind of move. Imagine you think of a limit, price has to hit it and bounce off, has to hit it and bounce off. A stop is different. A stop's basically saying, hey, and imagine for this argument's sake, that's 2,000. If the price hits 2,000, I'm going to buy. So a buy stop at 2,000 means, hey, if the price gets to there, get me long or enter me a long position now. If you have no position, that will get you long into the trade. You'll now have an open position long. If you are short and using a stop loss, as you know guys, that will just cover your position. You'll lock that loss in and you won't get any further loss. If you don't have a position, this is how you get into a breakout trade without having to be in front of the screen. So you can say, hey, if the market breaks above that, I want to get in, I'm going to put a buy stop at 2,000. That will trigger the long. If it carries on going to highs, great. If it falls back, then you're obviously going to take be in a loss situation. A stop limit order is the same type of thing, but this time you've got a bit more sensitivity to how you get filled. So a stop order will fill you with the cTrader account. So if you have a buy stop at 2,000 and the price shoots up, if it shoots up really, really quickly, you might get a bit of slippage. You might get filled at 2001 or 2002 because you said, hey, do you know what? I just want to get in. The market, the stop order turns into a market order as soon as that level is triggered. That's really how it works. Like an extra processor goes, hey, what's the level it gets triggered? 2,000. Yes, is that triggered? Yes. Right, now send a market order. It's basically an automated way of you sitting in front of your screen, waiting for the price to hit 2,000, then hitting a market order. It just automates that process for you. But if you want more control over the price you get filled at, then use a stop limit order. And the stop limit order basically protects you from getting into a trade or even covering a loss which you maybe don't want to take a huge amount of slippage on. If the market suddenly rips through your levels, if the market suddenly rips through, if you think about what happens when you're placing a market order, if you place the market order at 2,000, by the time it gets filled, it could be 2001, 2, 3, could be 2010, it could be even bigger in the case of a real news event that causes the market to absolutely rip. So in that case, you might want to use a stop limit order, and all that does is it has the stop component, the trigger component, which is 2,000. And then rather than sending a market order like a traditional stop order into the market, it sends a limit. So it combines the stop and the limit rather than just the stop and the market order. And what does that mean? It basically means, okay, if you've got a stop order at 2,000 and let's say your limit is 2002, what that basically means is it will fire a limit buy-in, if this is a buy stop, at 2002, which means if the price at the time it hits the market is 2010 or more than 2002, it won't be filled, so you're not going to get that slippage. So it's perfect for getting into a trade. Now, if you're getting out and you're maximizing and kind of minimizing your loss, you might just have to swallow the slippage you want to get out of the deal. But if you're getting into the trade, if you're using the stop to get into it, you might say, you know what, if it rips up and just kind of goes, then we'll get filled at 2010 or 2015, too much. 2002 or nothing. And so that's how a stop limit order works. It allows you to specify the level that you get in, the maximum price you're prepared to pay if that stop is triggered. And again, if you talk about kind of operationally when you might want to use that, your market orders you're using just when you see an opportunity now and you want to pull the trigger long or short. Limit order, you're waiting for the market to come back to you. Market wants to rotate down. Below the market, long limit. Above the market, sell limit. That then kind of is fading like a mean reversion type play. Market's pushing up, you want to get short. Market's pulling down, you want to go long. Stop to get out of a trade to cut your loser, or using its own when you don't have a position to get into a trade. That's a breakout type scenario. Imagine a range, you want to buy if it breaks above the top of the range. Using a buy stop, you want to sell short if it goes below the range. You'd use a sell stop. Pretty simple stuff, pretty easy to do. And the stop limit order just again allows you to have a little bit more granular control over the price you get filled at, or say, hey, it's got to be this price or nothing at all. Anyway guys, we're going to have a little play around in the cTrader platform. Take care, bye bye.